And good day, everyone. It's a pleasure to have you today on this very interesting discussion around economic and industry opportunities in 2026. And I think the outlook for 2026 becomes particularly significant considering how we are navigating a world that is driven so much by trade upheavals, by geopolitical realignments, by supply chain recalibration, and a wave of protectionism. But at the same time, we're also witnessing something that is equally powerful. We're witnessing record levels of strategic deals happening, bilateral deals. There are new free trade agreements getting struck, new trade corridors, digital acceleration, and all that seem to be stepping stones for globalization 2.0. So, as businesses conduct strategic planning for 2026, we have designed this particular growth webinar to answer some of your top of mind questions, in the sense of are we expecting to see a major dip or a rise in global growth in this year? With all that news that we are hearing about trade policy changes, the new trade deals, and even the very recent announcement of President Trump's new tariff, coming into effect at 10% instead of 15% rate. So, of course, given all of these uncertainty, a question arises, how should businesses separate signal from the noise? Where are the real risks? And more importantly, where are the durable opportunities that the businesses can leverage? And to provide some of these expert insights and more, I'd like to introduce you to the rest of the panel. We have Nikita Talnikar, who is a senior research analyst and a strategist with the economic analytics practice here at Frost & Sullivan. Also pleased to invite our industry experts, Abhishek Chatterjee, senior consultant and growth expert from our logistics and supply chain practice, and Joe Praveen, associate director and growth expert with our mobility practice. A warm welcome to my fellow speakers. So very quickly moving over to the agenda of what you can expect over the next 30 minutes or so. So we will start off with 2026 economic highlights and outcomes, very quickly summarizing what do we expect to see in terms of GDP growth figures, where has inflation leveled out at, and trade flow predictions and things like that. Then we will segue into some of the geopolitical events and flashpoints across regions. And also we will talk about key growth expectations and opportunities. We will then move beyond the macro headlines and give it to Abhishek and Joe for their expert insights on industry level shifts. And also they'll talk about business strategies. Of course, this will help you translate uncertainty into informed decisions on things like investment, on partnerships, or risk management, right? So yeah, that's about it from today's agenda. I'll quickly start off, with laying the foundation with the GDP growth projection. If we can move to the next slide. Thank you. So this particular slide is like a weather report where we quickly try to give you a glance through the GDP growth expectations for key countries in the world. And let me start off with the global picture. So we are looking at a global growth of 3.3% in 2025, easing slightly to 3.1% in 2026. So yes, there is a moderation, but we are still looking at a global GDP growth, which is 3% plus, which is still quite sturdy. And all thanks to the spillover impacts of monetary easing that happened last year, and also the fiscal easing, the tax cuts, and the ongoing AI investment and the consumer center, the resilience that is coming from the consumer side of things. Now let's look at some of the countries and what's impacting growth in these economies. So looking at the US growth, so US should, of course, US, I think, is the fastest growing G7 economy. And of course, when we look at the US economy, growth moderates slightly from around 2.2 to 2% in this year. However, the US economy remains fundamentally stable, and it is absolutely supported by consumer resilience, ongoing investments in AI and data centers. We also see tax cuts and also business-friendly policies such as the OBA. The administration is also likely to double down on efforts to boost growth, particularly ahead of the midterms. But in case if trade tensions escalate, that might push the Fed to pause on the rate cut in this year. So that might temper momentum to some extent. Moving over to Europe, so looking at Germany particularly, so Germany shows improvement, so edging up from closer to 0% last year to closer to 1% in this year. So that's definitely a sign of recovery. And what we see is the energy shock effect. So that's started to ease, and also manufacturing is also started to stabilize. Now, when we look at the UK economy, so UK on the other hand sees growth slowing slightly from around 1.3% to less than 1% in this year. Inflation stabilization in the UK has definitely helped, but things like consumer pressure, so that continues, and also trade frictions continue to weigh the UK economy. Moving over to Asia, looking at Japan, so that also Japan economy moderates from 1.1 to below 1% growth for this year, and that is mainly due to the demographic drag and the currency volatility. So these remain structural constraints for the Japan economy. Now, when we look at some of the emerging markets from Asia, we see China's growth. So that's expected to sort of stabilize, slightly moderate from 5 to 4.5% in this year. And that's mainly due to slower exports. But the good news is we expect consumption expanding modestly in China. Also, when we look at infrastructure and manufacturing investment around these activities and sectors, so that's also recovering gradually after what we saw a sharp slowdown last year, right? So, and when we think about the property downturn in China, so that would continue, but the pace of construction should ease. And then policy support also, particularly when we look at the innovation-driven sectors, the new economy sectors in China, so that are now a meaningful growth engine for Chinese economy. Looking at India's growth stories, of course, India remains the fastest growing major economy. It moderates slightly from 7.4% from the current fiscal to 6.8% for the next fiscal, but it's still clearly leading. And for businesses, India represents, one of the most compelling structural growth stories globally. Of course, we look at, strong demographics. We look at infrastructural expansion and manufacturing incentives. They continue to drive momentum for the Indian economy. Also, we also see outward policies like in the light of the new trade deals and the free trade agreements. So these, of course, boost growth, medium-term growth. Quickly looking at some of the Middle East countries, Saudi Arabia and the UAE, so they should also see growth edge up, and that's also largely getting supported by diversification efforts, large-scale infrastructure, then mega project investments, so that are sort of driving the activity. And for businesses, of course, this creates strong opportunities, not only for this year, but also over the medium term, or in across sectors such as construction, logistics, services, manufacturing value chain, and the like. So net, global growth softens slightly, but resilience remains intact and emerging markets continue to lead. So with that, we move over to the next slide. So here, I am going to be highlighting on some of the key economic transformations and key economic trends for this year. So we look at global real GDP growth. So of course, we discussed that just now. So that is coming down from 3.3% from last year to about 3.1% in 2026. A lot of, we saw a lot of this front-loaded trade activity that happened last year. That is gradually fading. So that's causing some part of the downturn. And the tariff noise also keeps the investment a little cautious. And this, when we talk about the slowdowns, that ties directly into the pricing trends. So let's look at what's happening with inflation. So on inflation, we expect price pressures to ease in this year, mainly because of oil prices, which are moving lower than average and mainly due to oil oversupply. And thinking about monetary policy, particularly for the US, when we look at the US, inflation is moderating, but still it's above the central bank's target range, right? And when we look at unemployment, so unemployment is also sort of steady, it's not really declining. So Fed is likely to hold rates steady with no cuts on the horizon, at least until growth remains firm and there is strong signals of disinflation in the US. Now, of course, we talked about inflation that is stabilizing, but the next big question is what's happening with the trade flows and supply chains. Now, trade growth is set to slow for sure in 2026, and of course, we talked about the trade front loading that happened particularly in the first half of last year. So that is going to fade to some extent. And this year, we are also seeing lag effects of higher tariffs and the ongoing volatility around trade policy and things like that. There is slowing global demand, and that will weigh on export growth. So, yeah, so these are some of the you know reasons, but we also do expect that AI-related trades that will continue to expand and will be able to offset the slowdown in import to some extent. We talk about labor very quickly. So on the job side, things stay steady and unemployment rate holding at around 5%. And behind the scenes, though, of course, AI-driven investment that is creating strong demand for, particularly for high-skilled talent. Of course, we also see with that some of the entry-level roles continue to be automated. So, of course, we might see some layoffs, but the good news is we also going to see some new job creations happening, right? So yeah, so that's about it on this particular slide about talking about some of the important macroeconomic trends and numbers. And with that, I'll hand it over to my colleague Nikita, who will talk about some of the very importantly some of the geopolitical risks and flashpoints and growth opportunities. Over to you, Nikita.
Thank you so much, Ritu, for setting the context in terms of the global economic backdrop. Let me get to the core question of this webinar. Will geopolitical and supply chain flashpoints derail global growth in 2026? So, when we look at this map, we see that all of these flashpoints are not an isolated crisis. They are simultaneous pressure points which are emerging all across the globe. So, be it the Taiwan and East China Sea escalation risks, potential escalations between US and Europe due to Arctic shipping and resource competition, maritime choke points coming up, say in the Red Sea or the Panama Canal, US China trade fragmentation, which has been an issue for quite a few years now, as well as the US tariff uncertainty, which has been the theme throughout 2025 as well as 2026. All of these are not temporary shocks. They represent not only global trade fragmentation, but also fractures within technology and global security systems. So, economically, what does that mean? That is the key question our clients ask. It means that, firstly, trade flows become more regionalized, localized. They're increasingly determined by geopolitical alignment between the countries, the trading partners, I mean. Um, Supply chains are no longer just an equation of cost structures. Geopolitics, trade, tariffs are equally important considerations in supply chain decisions in these recent years. And lastly, as we see firms redesigning their production footprints, capital expenditure rises. So, organically, the capital intensity means that global growth is not going to decelerate, it is being reshaped rather. So, to answer my central question of this webinar, whether geopolitical and supply chain um, flashpoints are derailing growth in 2026, the answer is no. But they are critical in determining where the growth is flowing, which sectors are accelerating, and which regions are capitalizing this change in global investment flows. Now that we have spoken about risks, I also want to talk about the opportunities. This slide shows the key sectoral growth hotspots emerging across regions in this year. But notice something very important. Each opportunity is directly or somewhat linked to the fragmentation we just spoke about on the previous slide. So the same forces which are creating volatility, disruptions, they are also driving investment cycles and growth frontiers for global firms. So let's start with the regions. On the left, North America, AI hyperscaler capex is the core driver. US AI capex is expected to surpass around $500 billion in 2026, which means positive spillover effects for construction, data centers, power infrastructure, as well as semiconductors and electronics. At the same time, policy has been quite conducive in the US, be it the corporate taxes being cut down to 21% permanently, or the tax benefits coming in under OBBBA, as well as the targeted incentives. So, all of this, all in all, is accelerating reshoring. So, what we see is that geopolitical fragmentation, tech wars, is translating into domestic industrial acceleration within the US specifically. Coming to Latin America, for them, data centers have been emerging as a key FDI engine, and we have seen a lot of private investments going into nations such as Mexico and Brazil in this space in the recent months. Critical minerals, similarly, is showing a very strong investment upcycle in Latin America. So, nations such as Argentina, Chile, Colombia, with their policy support, they're helping the region position itself as a key node to global green industry supply chains. Similarly, nearshoring policies in Mexico, tax incentives in nations such as Peru, all of this is supporting production relocation closer to the high demand markets such as North America. So, supply chain diversification, all in all, is directly boosting regional investment flows for Latin America. Coming to the central part of the world, Europe. Defense spending is rising, has been a key theme and a growth driver over the past couple of years now. Germany alone, for instance, is expected to increase its fiscal spending for defense from $100 billion last year to around $130 billion this year. At the same time, we are also seeing data center, AI expansion, energy transition investments being strong. Similarly, critical minerals funding is also coming in from the European Union. So, all of this is showing a strong structural industrial pivot driven not only by security, but also by digital and tech transformation. Coming to the Middle East, the region in 2026 will continue to show non oil growth strength and AI infrastructure, as well as data center expansion, logistics, ports, supply chains, and trade integration are some of the key themes that we are noticing in the region. So, the Middle East's geopolitical alignment with key powers across the world, as well as geographic centrality, which connects it to key trade partners, is turning it into a trade and logistics advantage for this particular region. And lastly, Asia Pacific. China is moving further up the high tech value chain, as has been their policy target for quite some time now. Semiconductors, AI chips, defense, robotics, EVs. Similarly, India and ASEAN, just like Latin America, have been benefiting from the diversification flows. And most importantly, as Ritu also mentioned, India remains a global demand and growth hotspot, which supports consumer centric segments, including automotive and mobility. So, what I just described at the macro level, be it AI investments, defense outlays, critical mineral support, logistics corridors, nearshoring, all of these trends are driving sizable and noticeable sectoral shifts. Industries are reconfiguring themselves and their operations, their strategies to changing global economic and geopolitical backdrop. And this is exactly what we will explore in the upcoming sections. I will now hand it over to our supply chains expert Abhishek to guide us on how supply chains and industries are reacting to and monetizing this trade reorientation and fragmentation in this year. Over to you, Abhishek.
Right. Thank you, Ritu, and thank you, Nikita, for setting the background with the global fragmentation and the geopolitical flashpoints. So, as we move to the core and the burning question, what does all of this mean for the supply chain ecosystem? Well, these shifts that we were discussing previously reverberate across multiple stages and multiple geographies. So we'll go across the drivers one by one and understand the macro supply chain factors. So geopolitical tensions are now redirectly influencing freight behavior. The Red Sea crisis alone has rerouted vessels across the Cape of Good Hope, adding 10 to 15 days extra in sailing days, which raises fuel costs, which raises charter costs. And this has disrupted one of the world's highest volume east-west corridors. And moving on to the next driver, value chain fragmentation. So there's various complexities that we have to take into account. The global value chain accounts for approximately 60% of the total global trade. So we are seeing fragmentation in the manufacturing footprints. For example, if we take a garment brand may source cotton from one country, they would weave the fabric in the second country, manufacture the clothing in third, and then the end user would be in a market in Europe or North America. So this explicitly mentions redistribution of the supply chain, but also exposure to the value chain, which ties into the next point of manufacturing regionally and nearshoring. So there is an accelerating shift towards this model where companies are deliberately spreading production across different hubs. So whether it be Southeast Asia, Middle East, Eastern Europe, and also prime example would be Mexico as a nearshoring model. So this is all done in order to reduce the systemic exposure to the fluctuating tariffs, which is always uncertain in this moment of time. In terms of the supply chain based strategies, the ability of an organization to anticipate, to absorb, and adapt to these disruptions becomes really key, where they can leverage real time data and take steps proactively. And this has currently become the lay of the land for risk management for these suppliers. Moving on to the human resources and skill gap, in terms of modern logistics, there is a talent crunch spanning from manual labor to high skill management positions. So there is not a slowdown of adoption of using new platforms and new technology, but it is about having the technical skills to use these platforms and capability to automate as much as you can in the supply chain um, going forward. So this brings to the point of digitization and AI development, where digitalization is being reorganized by AI. If we look at it, the US is accelerating AI based supply chain systems, and this requires massive data centers, it requires semiconductors, it requires cloud infrastructure, which ties into the point of critical minerals. Critical minerals are now one of the core, or rather the backbone of two or three different verticals, which includes, of course, AI infrastructure, but also electric vehicles and the energy sector. So we see that critical minerals is now also a strategic part in the global supply chain. Moving on to the regulatory landscape, uh, countries worldwide are lowering or eliminating the de minimis exemptions, and this is reshaping the e-commerce flows. We have talked about the tariff baselines fluctuating, and this is pushing companies to rethink sourcing strategies. And in Europe, with their induction of the sustainable solutions using CBAM have brought about different avenues of taking care into the sustainable aspect. Finally, in trade realignment, we see that there are different corridors which are being formed, such as the IMEC corridor and the Lobito corridor for critical minerals. And this is how we see the freight movement would take place. Moving on to the next slide, where I talk about two different dimensions which are right now interconnected. So one is the physical trade, and second is the digital trade. And digital trade right now includes AI models, includes AI infrastructure that is being exported across. So beginning with North America, which remains the powerhouse with 47% of the world's data center capacity. And this is by design. The US administration wants to position itself as a primary exporter of AI capability. And along with this, in terms of physical trade at the moment, Canada and Mexico have preferential and beneficial tariffs which support them compared to other Asian countries. Moving on to South America, although it's just 3% of the global data center compute capacity, but it plays a very important role because of especially Europe's vested interest. The EU Mercosur trade takes place around $135 billion annually. And as Nikita was mentioning, there has been a lot of FDI coming in from EU, close and above $400 billion in the region so far. So it shows that even though a country with rather a continent with low compute share will weigh in physical trade alignment very soon. Moving on to Europe, which holds the second largest global data center capacity, they are taking various initiatives. The 200 billion euro AI Invest AI initiative is to build gigafactories, GDPR compliant data sets, and at the same time, it's a bit of a power play where they are focusing on free trade agreements like with India, where it opens up a new corridor in potential sectors like automotive, pharma, and other essential commodities. So the strategy is quite clear. They want to control data, they want to control negotiations, and also control commodity flow. Moving on to Asia Pacific, it's around 19% of the global data center. India actually benefits fairly from the revised tariff structure, as US is its largest trading partner at around 18%. And in the handshake agreement taken place in recent days, 40% of India's exports benefit from a certain tariff reprieve, which allows US to share data center and GPU related technology in order to align with the US AI ecosystem. China, meanwhile, has expanded zero tariff access to 53 African nations, taking steps in order to strengthen its own position, and also the South South supply chain corridor. Finally, in terms of the digital trade aspect, I would just mention that China, Japan, and Korea are highly adopting AI in electronics and advancing manufacturing. So we see them adopting at a very fast pace. And finally, to talk about the Middle East, they want to position themselves as a neutral digital and physical trade corridor. So the Middle East Africa holds around 5% of global compute today. But on the digital side, we have Saudi Arabia making investments of around $100 billion in data infrastructure, vis-a-vis UAE with its AI strategy 2031, investing in projects like Stargate to position the Gulf as a high digital compute hub. And on the physical side, because energy and many other similar derivatives have been exempted from the US global tariff, leveraging this to build the IMEC corridor and the GCC multimodal corridor. Moving on to the third slide, where we talk about what it means operationally, there are several structural shifts, and I will be highlighting a few of them. In diversification, we see that companies and suppliers are moving from the China plus one strategy to China plus N strategy, where companies deliberately diversify their production requirements across regions to mitigate the tariff risk. Second, if you look at resilience. Supply chains are being redesigned and reintegrated. Having buffers, having multi-location warehousing are certain measures taken by suppliers in order to have continuity and not have ad hoc breaks as and when the tariffs are changing. In terms of AI enabled optimization, AI has now moved beyond pilots. It's now full scale operations. Agentic AI has taken a strong role with route optimization, where there are 15% delivery efficiencies and higher improved unit economics. So, AI operating system is the new modern logistics. Warehousing is going through the same automation curve as it did 10 years ago. Computer vision is playing an important role, robotics, IoT as well. Talking about critical minerals, critical mineral is geographically concentrated in China due to its uh, mining infrastructure and related infrastructure investments across the years. So countries are now securing supplies through different corridors, different MOUs. So we see the Lobito corridor, which includes Angola, the Republic of Congo, and Zambia becoming the alternatives. And talking about the final 2 points, e-commerce is now in an intersection of automation and omni-channel uh, economics. So we operate in a world where delivery promises are of as soon as possible, higher SKU complexity. So there is a change in the fulfillment architecture. And finally, talking about multimodal transportation and corridor integration, it's very interesting. Logistics is shifting from corridor specific optimizing to mode based optimizing, where GCC is a very important example. Uh, the GCC rail is expected to unify the sea, road, and rail into a seamless multimodal ecosystem, which strengthens the Middle East position, and also with their strategies of IMEC and IRC with Iraq playing an important role. So, stepping back, the common thread across everything we've discussed is tariffs, rerouting around the Red Sea, the China plus N strategy, and also the role of critical minerals in AIs and electric vehicles. So, I will now pass it back to Rituparna to talk about and take it to the next section.
Thanks, Abhishek. Thanks. Great insights. So, as I understand, global supply chains are shifting from, as you said, single region efficiency models to sort of multi regional to resilience driven networks. And we definitely see nearshoring, things like dual sourcing and just in case inventory strategies are becoming more prominent. So, great. So, with that, I now hand this to Joe, our mobility expert, to cover his perspective on the mobility outlook for 2026. Over to you, Joe.
Thank you, Ritu. Hello, everyone. The automotive team within Frost & Sullivan publishes the Global Automotive Outlook at the beginning of every year. And as part of the outlook, we try and come up with a list of trends, the top 10 trends, which will drive the automotive market in that particular year. So what you're seeing on your screens now are the top 10 trends that we've identified for this year and which will be critical for automakers to take note of and to succeed and navigate through this year. And as you would see in this slide, a lot of these trends resonate with what my colleagues shared earlier. So we are talking about a broad theme of different trends which are now converging and impacting or influencing the automotive industry now. So we're looking at AI agents inside the vehicle cabin, the need for increased investments in cybersecurity, and there is also policy realignment which has happened around electric vehicles towards the end of last year, which now makes automakers to rethink and recalibrate their powertrain strategies as well. And there is also focus on reducing the vehicle development time, the advent of Chinese automakers, where they have managed to reduce or shrink the vehicle production time from anywhere between 18 to 24 months has put pressure on legacy Western automakers to catch up with that pace of development as well. So there are a whole host of different themes in the top 10 trends that we've identified for this year. But for today's session, we've identified three trends which will align with the theme of the briefing today. So the first one is, as we see here, the acceleration of manufacturing nearshoring. Ritu and Nikita talked about regionalism and protectionism. So this sort of plays into that theme as well. So we look at the key drivers within the automotive industry for this trend. Obviously, the tariffs and trade barriers play a key role. We saw President Trump introducing a lot of different tariffs all through the past 12 months. The ultimate aim of most of these tariffs was to bring back manufacturing into the US. And the companies have realized that and they've started reacting to it. A lot of companies have announced that they'll bring back overseas production into the US or increase their investments in existing US manufacturing facilities. For example, General Motors has announced that they'll relocate the production of the Buick Envision from China to the US by 2028. Now, when it comes to the European Union as well, they've been looking at what the Chinese automakers have been doing, where they've been bringing in vehicles from China into the European region for sales. And now the EU has started levying duties on those imports. So the Chinese automakers are also now forced to look at producing locally within the region. So BYD, for example, has already started setting up two factories in Europe, in Hungary and in Turkey. And another factor which is driving this nearshoring trend within automotive is the desire for automakers to make their supply chain more resilient. So we've seen the previous speakers talking about making the supply chain resilient as well and how the companies are focusing on it. The COVID-19 pandemic and the geopolitical tensions which followed the pandemic have now made the automakers realize that they can't depend on long shipping routes where they source their materials or finished goods from halfway across the world, and they need to localize and make things where they're actually selling them. So that's another key driver. Another advantage which sort of feeds into this trend is the fact that there are low-cost centers which are available close to the key markets where the automakers are selling their products. For example, Mexico is close to the border with the US, so that's an strategy which automakers are leveraging as well. And as we saw with the case of BYD and a lot of other automakers, countries like Hungary and Turkey provide a low cost option and act as a gateway into Europe as well. So going forward in 2026, the key focus for automakers will continue to be to build where they are selling and also to look at and reevaluate their extended ecosystem and see if they can source locally as well or partner with local suppliers as well. So that's with that trend, we can move to the next one. So Abhishek talked about critical minerals in the context of electric vehicles. So rare earth materials are critical to the automotive industry. A lot of different components are dependent on rare earth materials. Specifically, the EV motor, which is dependent on rare earth magnets. And as you know, China controls nearly 90% of rare earth magnet production. And last year, there were some issues with curbs on exports of such materials to other countries, which disrupted production. So automakers are now trying to work out ways in which they can circumvent this situation. So they're adopting and looking at different strategies. Some are looking at developing components which have low to zero rare earth materials or magnets in them. And others are trying to stockpile as much as they can for the short term while some of the other automakers are lobbying with governments for their help or trying to invest in domestic supply of these materials. But the most feasible strategy for the short and medium term seems to be to look at options to develop components which are not dependent on rare earth materials. For example, Stellantis partnered with Neuron Magnetics to develop electric motors for cars using magnets which are devoid of any rare earth elements. Similarly, BMW is now developing a low to zero rare earth motor, and their upcoming iX3 vehicle is expected to be powered by motors which generate their magnetic field through electric current than by using permanent magnets. So the key focus for 2026 for automakers would be to continue to look for ways to develop components, and especially the electric motor, without using or being dependent on rare earth materials. They will also try and invest in domestic mining and refining of these materials. But again, that's a long-term strategy. Another strategy which could work in the short term is trying to salvage these rare earth materials from end of life vehicles or components, where they can use circular economy principles to salvage some of these critical minerals. Next trend, please. Now, this is an emerging trend that we've witnessed happening in the recent past. As you know, after the COVID-19 pandemic, in the past 3-4 years, Chinese automakers have increased their influence, and they've grown and they've expanded into new geographies, apart from competing in a strong market domestically as well. So they've been successful outside, and the Western OEMs have been taking note of what they are doing differently. So some of the reasons why we feel these partnerships are happening now would be the first one could be the technology gap that they are now taking note of, the Western OEMs. So they feel that the Chinese OEMs have been good at adopting technology and digital tools to offer higher customer experience within their vehicles. For example, they're offering better features, and the pace of software updates are also pretty rapid when compared to what the Western OEMs are doing. So the Western OEMs feel that partnerships with Chinese OEMs can enable them to acquire these capabilities as well. Another reason would be obviously the cost efficiency. The Chinese electric vehicle market is a mature one, and their supply chain is also extremely mature, which means it is extremely cost effective as well. So the Western OEMs feel that they can leverage that supply chain through these partnerships to procure important components like batteries and power electronics at a cheaper price, which can reduce their production costs. Another key feature that we've noticed about Chinese automakers is they have a shorter production time, as we saw in the broad group of trends in the first slide. So they've managed to leverage technology and tweak the processes to somehow shrink their vehicle production time. And partnerships with Chinese OEMs would help Western car makers to leverage their processes to reduce their production time as well. Another key feature would be to gain access to newer markets. So the Western OEMs are still trying to, many of the Western OEMs are still trying to still get a foothold in the Chinese market, and vice versa. The Chinese OEMs are trying to keep expanding their global foothold as well. So partnerships like these will help them achieve synergies towards these goals. So when we look at the case studies as well, they reflect these four points that I just discussed. So for example, Volkswagen has partnered with Chopong to develop Volkswagen branded cars, two cars for the Chinese market. And Volkswagen is leveraging Xpeng's software and platforms to develop these two cars. And just last month, again, Ford announced that they will be buying batteries, electric vehicle batteries from BYD, which will be used in Ford's electric vehicle manufacturing facilities outside of the US. So the key focus for companies who are involved in these partnerships would be in 2026 to see if they can somehow co-develop platforms, software, and batteries which can reduce the production costs as well as reduce the time to market as well. They will also look at leveraging these partnerships to enter into new market and to localize production. And another key advantage that they'll be looking at would be to share the risks which would be associated with investments, and also to share the risks associated with regulatory and the trade and tariff related tensions which might arise as well along the way. So these are some of the key trends that I wanted to highlight from the mobility perspective. So if you're interested in a deeper insight into the automotive space and what happened in 2025 and what is in store for 2026, we have a briefing which is coming up tomorrow. And we will be sharing the link to that briefing later on in this session as well. And if you're interested, you can join that briefing as well. Thank you.
That's right. Thanks. Thanks, Joe. Okay, so great. So, Joe, what I understand is that the automotive strategy is definitely shifting toward regional resilience, where we see deeper localization of batteries, of components, and we also see production recalibration around, these new evolving trade rules, and of course, stronger focus on, as you said, domestic sourcing for critical minerals. Thank you so much, Joe. So, and in summary, what we understand is that global economy is currently moving toward a scenario of subdued growth, yes, but that's again, we are talking about a 3% plus growth. So, reiterating what Nikita said earlier, so, while flashpoints do hold a growth below the pre pandemic average, but generally, we definitely avoid a large downturn or a recession. So, yeah, so great. So that brings us to the end of our presentation, and I think we just have enough time to go into a couple of questions that I see coming from our audience. The first question is, I think this is for Joe. Can you explain the policy realignment around electric vehicles that you mentioned in your first matrix slide? Does that mean that there will be resurgence in ICE vehicles again?
Yeah, I think the policy realignment was specifically aimed at two of the major markets when it comes to automotive. The European Union, which rolled back its planned ban on combustion engines by 2035, and the US, where President Trump has cut EV incentives, as well as he's frozen the plans for expanding the charging vehicle infrastructure as well within the country. So these two have forced automakers to relook at their powertrain strategies. So companies like Ford and Stellantis have already announced that they'll focus more on hybrids and extended range electric vehicles more than battery electric vehicles in the short to medium term. So we feel that the long-term battery electric vehicle story is still intact, and we feel that this is a way to get to that eventually. So in the short term, there'll be focus on hybrids and extended range electric vehicles in Europe. And there could be some resurgence of ICE vehicles in the US because of the policies of the current government. But I think that will be closely aligned with the Trump presidency tenure as well.
Okay, great. Thanks, Joe. I think that there's just another question. So this is for Abhishek, I believe. So it says, what are the most practical steps companies should take right now in order to boost supply chain resilience?
Right. Thank you for that question. There are certain given points that suppliers are usually following. For example, the China plus N strategy or the inventory buffers that they need to keep in order to manage the tariffs. But I would probably keep it as a framework that all companies should follow, a very simple 3-point framework. First is that identify the risk um, by looking intrinsically in your as is supply chain. There might be certain blind spots because in all this chaos, it tends to get overlooked. So there is a lot of data which is residing with them. So they can look at that and always embrace technology to help with that. Second is after this analysis, prioritize because of understanding their capabilities and their weaknesses. They can focus on which part of the value chain or which part of the supply chain they're most vulnerable to, and they can have focus points on that in order to take care of it. And finally, it would be recalibration. I think it's important that it's to learn from the first two steps, that what did we learn from our supplier pattern changes or which route is becoming the most volatile. So it's all about self-correcting and adapting as fast as possible in this uncertain times in this last few quarters.
Absolutely. Absolutely. Agreed. So I think we're pretty much on the hour. So with that, I thank our speakers today. We were able to bring out some very interesting conversation and insights for our audience today. So thank you, Nikita, Abhishek, and Joe.